Hello, everybody. My name is Barbara Hansen, and I would like to welcome you to the KPMG Tax Summit of today. So despite COVID, the last couple of months have been extremely busy for finance and tax professionals in Qatar. So first of all, TAS, the old filing system, has been stopped, and the new filing system, Dhareeba, has been introduced. And we all experience some hiccups. However, they are, of course, very usual when a new system is introduced, but we are still suffering a bit on that. And second, Qatar is introducing more and more reporting requirements, just transfer pricing declarations as an example, but there are many others as well, and we will also try to cover these today. And last but not least, we are expecting VAT to kick in very soon. And one of our themes of today will also be VAT and what you need to do in order to be well prepared. But before we come to the content, I would like to give you some administrative remarks. We will have enough time to address your questions. However, they will be addressed at the end of our webinar. Also, please note that your mic is muted, so please send us your questions on the chat panel. You will see it on the right side of your laptop. And please make sure that you address your questions to the panelists, so not to the host and not to the speakers, really to the panelists, because then we can see them all and make sure that they are addressed. I also kindly ask you to keep the questions in general nature. Very specific questions on your case will be hard to answer, and we will probably not have enough time to do that in here. Second, I would like to let you know that the session is recorded. So we will send you the recording, so you will also have time to listen again if something was not clear, or you want at a later stage to listen in. And of course, it would be great if you could give us your feedback on the session, but also on future sessions you would like to have. So at the end of our webinar, you will receive a short questionnaire, and it would be great if you could answer it. So then let's see to today's presenters. So beside myself, we will have Imran and Abhishek. Imran and Abhishek will be in charge for the Q&A session at the end. So they will make sure that all your questions are addressed, or either by themselves or passed on to the other panelists. The content of today will be covered by Khalil. Khalil will talk to the news on corporate income taxes. Then Uma will cover transfer pricing, and Nurlan will speak about VAT. So with that, I would like to hand over to Khalil. And let's start with the direct tax update.
Thank you. Thank you very much, Barbara, for the enlightening introduction. And good morning, everyone. So from corporate income tax perspective, I would start with some hot and changing news regarding the income tax obligation and the deadlines for submitting the income tax returns. So if I ask the following question, who must file the income tax returns in Qatar for financial year 2020 onward? What will be the right answer? The answer to this question, ladies and gentlemen, is that all entities in Qatar having a commercial register or a tax card, and without any exception, must submit their income tax return via the new tax system, Dhareeba. The circular number 2 for financial year 2021, issued recently by the GTA, has confirmed that statement. However, it is important to differentiate between two categories of taxpayers, depending on which the standard tax return model or the simplified tax return model will be used for filing purposes. So we have here the first category, which is related to all taxable entities, foreign entities and taxable entities, as well as 100% Qatari or GCC owned companies with either share capital of 1 million or above, or revenues of 5 million or above. So I want to clarify here that if one condition is fulfilled, then the standard tax return needs to be submitted. It's not those are not cumulative conditions. The second category is for the 100% Qatari and GCC owned entities with share capital below 1 million riyal or revenues below 5 million riyal. So this category will be required to file only the simplified tax return. Furthermore, we would like to recall that the tax returns must be accompanied with the audited financial statements if the taxpayer's revenues are higher than 500,000 riyal or the share capital is higher than 200,000 riyal. So just for your information, please refer to Article 33 of the Executive Regulations, which provides for such conditions. All right, so having discussed about the tax filing obligation, now what about the regulatory deadlines to complete the submission of income tax returns? Dear clients, please note that a circular was recently issued by the GTA granting an extension of the deadline for the submission of the income tax return, except for companies operating in oil and gas and petrochemical industries, which still need to submit their tax return on or before 30 April 2021. So please allow me to repeat myself here and highlight again that no extension is available for oil and gas and petrochemical companies. For other entities, 2 new deadlines are available depending on the nature of taxpayer. For foreign entities or partially owned Qatari companies, the new filing deadline is set to 30 June 2021. For fully Qatari GCC owned companies, second category, the filing deadline is set to 31st August 2021. So last but not least, we would like to highlight as well that the transfer pricing declaration submission deadline will follow the deadline for submission of the income tax return, depending, of course, on the nature of the taxpayer. So it will be either 30 June 2021 or 31st August 2021. I will not go into much details here. My colleague Uma will give further explanation on the transfer pricing declaration in the next section of our webinar. Okay, then perfect. Let's move now to the next slides, where we will recall some tax exemption scenarios, which let's say were not crystal clear and for which we want to bring some clarifications and updates. First case is related to listed entities and their subsidiaries. First of all, it should be noted and that listed entities themselves are exempt from income tax without any specific requirement. For the subsidiaries of listed entities, the issue or the gray area that we had in the past is how to determine the ultimate foreign shareholding. As you surely already know, the report from stock exchange mentions only one layer or one level of shareholding. Then you will agree that it becomes a difficult exercise to determine the ultimate foreign shareholding. So in this regard, please note that we have recently discussed this issue with the General Tax Authority, and they insisted and clarified to us that it is the responsibility of the taxpayer to prove and ensure that the ultimate foreign shareholding percentage is accurate. So to avoid any future potential adjustment, it is key to ensure that the ultimate foreign shareholding is accurate. There is a second exemption scenario that we wanted to discuss. So in the next slide, which is which are the companies, the 100% fully owned Qatari companies or GCC owned Qatari companies. So we all know, and obviously that these entities are exempt from income tax. However, there is one condition which we need to address. So it should be noted that 100% fully owned Qatari companies or 100% GCC owned companies will only be tax exempt if the GCC shareholders or the Qatari shareholders are tax resident in Qatar for the year that is reported, for the year subject to tax declaration. So it is important here also to highlight that, and not to confuse the concept of tax residency with the simple residency. The example given, shareholder having a QID in Qatar doesn't necessarily mean that he is tax resident in Qatar. So for an individual to be tax resident, he must have his permanent home in Qatar. He must have spent more than 6 months in Qatar for the year reported. For example, for 2020, he must have spent more than 6 months during 2020. Otherwise, his share may become taxable. And also the third condition, or the third case, the shareholder has his center vital of interest in Qatar. So these are the three conditions for an individual to be considered as a tax resident. For a GCC legal person shareholder, because we can have an individual and we can have an individual shareholder, and we can have also a legal person shareholder. So for a GCC legal person shareholder to be tax resident, it must be incorporated under Qatari legislations. Otherwise, it will not be considered as tax resident. So for your information, you can refer to Article 1 of the Income Tax Law, which provides for such conditions. Lastly, and without spending too much time on it, we wanted to address as well the case of Qatari companies indirectly owned by Qatari individuals on multiple layers or level of shareholding. So you know that in the past we had this confusion that the companies may become taxable as they are indirectly owned by Qatari individuals. So there was some different interpretation of the law, etc. It was not clear in the past. Now, after the issuance of the circular by the GTA during financial year 2020, it was clarified that these companies are exempt from income tax without regard to the number of layers or levels of shareholding between the Qatari taxpayer and the ultimate Qatari individuals. However, please note that there is a form which needs to be prepared and filed along with the tax return, which proves that the ultimate shareholders are Qatari individuals. Okay, so perfect. Hope the aforesaid was clear and helpful. I will move now to another subsection under which I will provide some key flash notes about the new tax system Dhareeba, as well as some recent updates from GTA. I will start with the Dhareeba balances or amounts shown as overdue on the portal. So please note that it is key to review these balances to determine if they correspond to genuine tax and penalties, or maybe sometimes some differences, mistakes due to the transition from the old tax system to the new tax system. 3 main actions can be taken depending on each case. First case, if the amounts shown have already been paid, action to be taken is to submit the proof of payments to GTA and request the same to update the system. Second case, if the amounts are wrong, not detailed, not justified with any previous tax assessment, the action to be taken is to take the objection route and submit an objection letter to the General Tax Authority. Third case, if the amounts of penalties are genuine, to submit a penalty exemption request to GTA, providing all reasons for delay in filing or payment. If the amounts are not significant, you may decide to pay and clear the system. Therefore, we highly recommend that you review your Dhareeba portal, and of course, KPMG can definitely support you in this regard. We have successfully rendered the services for many of our clients. So please reach out to us if you have any of these cases. We wanted also to shed light on another topic, which is the requirement to submit the Arabic audited financial statement. So as you know, the circular was issued in 2019, providing for the obligation to prepare and submit the financial statements in Arabic. As per our last discussion with the General Tax Authority regarding this point, this obligation shall be applicable starting from financial year 2020. We are currently discussing with them, with the GTA, for the possibility to postpone this obligation, because we understand that it may be hard now due to the lack of time, but nothing guaranteed as for now. We didn't receive any official response as for now. So unless a further notice is issued, this obligation will be applicable for financial year 2020. I will move now to withholding tax. So, and just to give a quick reminder, so all withholding tax filings must be done through Dhareeba using the new GTA bank account. So the old GTA bank account should not be used for any purpose now for withholding tax. Also, we wanted to clarify that for the old obligations related to previous years, the old filings, a special request must be submitted to the GTA to open the old periods. Lastly, I will briefly address the contract reporting obligations. So first of all, please be reminded that contract reporting is applicable to all taxpayers without any exception or regard to their tax status, with whether they are Qatari or foreign entities. So it is applicable to all. Second point that we wanted to highlight is that both contracts with suppliers and with customers need to be reported, taking into consideration some thresholds referred to in the law. There was a confusion in the past that it was only the supplier's contract which need to be reported, but we received the confirmation from the GTA clarifying that, and also Dhareeba is also equipped and showing both options for suppliers and customers. So it is clear now that it is applicable to both. Without that, it would be useful, to share with you a summary template of the information required and which needs to be filled on the system. So as you can see, you have like in the information required, contractor's name, the contract reference number, nature of services, work performed in Qatar, the split between work performed in Qatar, work performed outside, short description of the substantive condition of the contract, description of special formalities, short description of notifying party obligations, etc. So you can see that the information required is quite extensive, and that's why it needs to be filled and entered carefully, as it may have an impact during tax assessment. So for your kind information, we understand from our exchanges with the General Tax Authority that these contracts will be used by GTA for assessing corporate income tax, withholding tax, VAT as well, and maybe also will be used for transfer pricing purposes when we are talking about contracts with related parties. So, and as you may know as well, it becomes now a global practice, to have a special department in the tax authorities, which we can call is the matching department, which will match the figures between taxpayers. It is then key to fulfill this obligation in the most accurate way. Let's move now to the last slide from corporate income tax perspective, under which I will address the main steps for requesting a non-objection certificate for change in ownership or share transfer. So first of all, please note that all the requests for non-objection certificate for share transfer must be requested through Dhareeba, except when you have a transaction occurring between 100% Qatari companies. In this case, a manual submission can be done, and the stamp on the share transfer agreement can be obtained manually. For the other cases, there are 4 steps that need to be completed in order to request for the NOC. First step is that the seller and the buyer need to register on Dhareeba, including if we have a non-resident seller or individual, he needs to do the registration on Dhareeba. Second step is that the seller needs to complete the capital gain tax return and proceed with the payment of this capital gain. Of course, if the company is in loss, or that there will be no capital gain tax, even if the process still needs to be completed, but it will show in the cost of purchase, etc., that the company is in loss, and then the capital gain tax will be equal to 0. So, but even if it needs to be completed, which will generate a capital gain tax reference number. So this reference number, this capital gain reference number, will be used in the third step to request for the NOC through Dhareeba. So of course, the request for NOC will be done not through the seller profile, but it will be done through the company profile where the sale is occurring. Yeah. So after this step, once the NOC request is submitted, the buyer needs to log in into his Dhareeba account. They will receive a notification, share transfer notification, and he needs to approve and accept the transaction. So once the transaction is accepted, then the NOC, then the General Tax Authority will treat the information and the information, and maybe send you an additional request for information, etc., and then submit, issue the NOC. Lastly, and the last point, we wanted to highlight that it's really key to clear and update the Dhareeba system to proceed with the request for the NOC. So it is linked to the point we saw in the previous slides, which is related to the review of the Dhareeba balances. Why? Because if the system is not cleared, if the filing obligations are not accurately reflected on the system, it will not allow the company to request for the NOC. So it is key to review and update the system. And so that's it for my part. Thank you very much for your kind attention. Looking forward to receiving your questions on the corporate income tax part. And I will now hand over to my colleague Uma for the transfer pricing section. Thank you.
Thank you, Khalil, and hello, everyone. In this segment today, we will cover the implementation of the transfer pricing regulations, the updates from the GTA, and we'll try to provide an overview on the various documentation requirements in Qatar. So to start with the implementation of the regulations, as most of you would be aware that the transfer pricing regulations, and more importantly, the documentation and reporting requirements around transfer pricing were introduced under the umbrella regulations of the executive regulations issued in December 2019. So while these regulations were introduced, they were still in the form of framework provisions where details on due dates, thresholds, information requirements, and filing mechanisms were still not available. For most of 2020, there were no further updates or inputs from the GTA regarding transfer pricing. However, with the launch of Dhareeba in the second half of 2020, at least the filing mechanism and the interface for the transfer pricing compliance was made available. Very recently, the GTA released the resolution number 4, which is a transfer pricing focused resolution signed by the president of the GTA. This resolution covers the much awaited, transfer pricing guidelines, and it provides the confirmation and the stipulations on deadlines, thresholds, and the content requirements. The resolution also states that the full-fledged transfer pricing requirements will be effective from financial year starting 1st January 2020. So now we're looking at a fully enforced transfer pricing regulation, and we're already heading towards our first filings in the coming months. Now let's move on to look at what are the transfer pricing requirements and documentation requirements. So the first one is the transfer pricing declaration. This is more of a form that provides summary information on the business activities, on group intangibles being used by the taxpayer, and information around the related party transactions. Next comes the Masterfile. The Masterfile provides an overview of the group's business activities, its value drivers, the supply chains around each activities, and also provides information on the transfer pricing policies being applied in the group. The next one is a local file. While a master file is prepared at a group level, a local file is focused on a taxpayer, its business activities, and more importantly, the related party transactions and the analysis around these transactions. The last but not the least is the country by country reporting. The important aspect over here is to understand that this is being governed by a separate regulation, and this is applicable only for multinational enterprise groups where the group is headquartered in Qatar and where the consolidated group revenue crosses 3 billion Qatari riyal. The country by country reporting is not a new regulation. It's been there since 2018. So the new introductions that we are looking at right now are the transfer pricing declaration, master file, and local file. With this, we'll move on to understand what are the deadlines and the thresholds. So to start with the transfer pricing declaration, this will be applicable for all entities where the total revenue or total assets cross 10 million Qatari riyal. Now, the due date for filing the transfer pricing declaration is the same as the tax return. So, in a normal year, for a December year end, the deadline for filing declaration would be 30th April. But as Khalil has already mentioned, this year we are looking at 3 separate deadlines. So accordingly, the declaration also we will have 3 separate deadlines. So for all oil and gas and petrochemical companies, the deadline for filing declaration will be 30th April. For all foreign taxable entities, it will be 30th June. And for all Qatari owned exempt companies, it will be 31st August. Now, the important aspect around declaration is that it is applicable to entities which may have pure domestic related party transactions. So there's no specific need that there has to be a cross-border transaction. Even with domestic transactions, related party transactions, a declaration is applicable. Now, when we look at master file and local file, the main aspect over here is that the thresholds, due dates, and the filing mechanism is common for both master file and local file. So the threshold here is that the master file, local file will be applicable for companies where the the total revenue or the total assets will cross 50 million Qatari riyal. There is an added requirement over here that it is applicable only to those entities where they do have a related party outside Qatar. So if there's a presence of a related party outside Qatar and you cross this threshold, then you need to do a local file and a master file. The deadline for master file, local file is 30th June. And this is as per the stipulation provided in resolution number 4. As of now, there has been no updates and no information on extension of these deadlines or this deadline. So we will look at 30th June as the deadline for these documents. The unique aspects of the two documents is that for master file, it is prepared at a group level. So if you have a group in Qatar where there are multiple entities, you will still have one common master file for all. However, a local file has to be prepared for each taxpayer separately. With this, we'll just understand what is the scope of transfer pricing regulations. So the scope of transfer pricing regulation is around related parties and related party transactions. Now in Qatar and in the Qatar tax law and regulations, there is no specific definition for related parties. Rather, there's just a reference made that it will mean the same as per the meaning provided in international accounting standards. So there'll be heavy reliance placed on the financials, and that's why it then becomes important that there is alignment between the transfer pricing reporting and the disclosures in the financial statements. So you'll have to ensure that both cover the same transactions and are aligned. Now let's have a quick look at the 3 requirements, starting with transfer pricing declaration. The most important aspect around transfer pricing declaration is the filing mechanism or the filing interface itself. So the filing of the declaration will happen through Dhareeba, but Dhareeba is programmed in a way that it will try to capture certain data points from the tax return, and based on those data points, the system will identify whether there is an obligation to file a transfer pricing declaration or not. Once the obligation is active, the tax return cannot be filed without the filing of the transfer pricing declaration. So here we are looking at parallel filing of the tax return and the transfer pricing declaration. Now, when we look at the contents of the transfer pricing declaration, it's more around, it has elements of both the master file and the local file. So it covers summary information on the main activities of the company and the group. The pricing policy is being applied to the taxpayer. It specifies the intangibles, the group intangibles that the taxpayer uses. And of course, it then covers the transactional information, providing specifics on the nature of transactions, amounts, jurisdiction of related parties, and more importantly, the most appropriate method of the transfer pricing methods that has been selected to analyze these transactions and to confirm the arm's length pricing for these transactions. Now, while the declaration doesn't specifically ask a taxpayer to state whether the transactions are at arm's length or to demonstrate the arm's length pricing, there is an underlying expectation and underlying understanding that if there is no transfer pricing adjustment being made to the tax return, then there is a confirmation, indirect confirmation that the taxpayers offering to say that the related party transactions are at arm's length. It is important to also understand that with this declaration, there will be focused transfer pricing audits under the tax audits. And hence it will be important to maintain sufficient backup to demonstrate that the pricing is at arm's length. You can also expect that at a time of assessment that the taxpayer would want to look at some level of functional and comparability analysis being done on these transactions, even for taxpayers who are not specifically required to file a local file. Now let's move on to understanding what a master file is all about. So like I mentioned, a master file is maintained at a group level. It captures the description of the group's business activities, the important drivers of business within the group. It documents the supply chain for each type of activity within the group. It covers information on intergroup services and intergroup arrangements. It talks about the main geographies where the group operates. And it also provides some level of functional analysis on each type of activity, or at least the main activities within the group. It also focuses on intangibles, provides information on the overall strategy of the group on intangibles, the location of intangibles, intercompany agreements and policies around use of intangibles, and also captures information if there's been any transfer of intangibles within the group. Now, the master file also looks at the financial activities of the group. So it captures information on how the entities are financed. Is there a central financing function, and which company or which jurisdiction manages that function? And what are the overall transfer pricing policies relating to financing? The master file also covers the annual financial statements and any information or copies on any advanced pricing arrangements that the group has had, or any tax rulings that the group has availed. Now we look at the local file. So like we said, the master file, all the information was on the group, but the local file is focused on the taxpayer. It focuses on the main activities of the taxpayer, the management structure and organizational structure within the organization at the taxpayer's level, It talks about what are the key competitors of the taxpayer. It focuses on the related party transactions, a description of each of these related parties, the values thereof. It provides a detailed analysis on the functional profile and characterization of each of the related parties for each of the transactions. More importantly, it also is supposed to document in detail the comparability analysis around each transaction. So selection of the most appropriate method, selection of the tested party, and then providing all the information available on the comparability analysis and the final comparables. And eventually the conclusion on whether arm's length pricing has been met. The local file also covers information on the financials of the taxpayer and the linkages between the financial statements and the information used for the comparability analysis. So with this, we have covered the three documentation requirements. So the transfer pricing declaration, master file, and local file. And while we have been focusing on documentation, compliance, and filing, it's important to understand that transfer pricing will have an impact on the taxpayer at various levels. So it could be in a more direct way where you're looking at adjustments and disallowances in the tax return, to more focused tax audits, to a little more indirect impact where, let's say, scenarios where a certain pricing has already been considered while deducting withholding tax or while paying VAT and customs duty. However, the same pricing could be eventually disregarded or rejected during a transfer pricing assessment. Transfer pricing could also have a broader impact where any business restructuring will have to be analyzed from a transfer pricing perspective. And at the same time, the outcome of a transfer pricing analysis could force a taxpayer or a group to look at opportunities to restructure their business. So it's important then to have a holistic view of the business, of the activities while doing the transfer pricing analysis, and understand its impact on the not just the pricing, but the procedures, policies, and the overall business of the taxpayer. With this message, I'll end my session for today. However, I just want to let you know that we are planning for a more detailed session on transfer pricing very soon, where we'll try to capture more on the regulations in specific, and also try to provide you some case studies that could be of interest to all of you. So please do look for the invitation for the next webinar. And with this, I'll hand over the baton to Nurlan to take you through the indirect tax session. Thank you very much.
Thank you, Ma. Hello, everyone. In my section, I will be covering VAT updates in the region and how to make sure that your business is ready from VAT point of view and how your business can implement VAT successfully. So before that, let's look at the VAT status in the region, and then afterwards I will be covering the basic VAT mechanism and also some challenges of the businesses. So if we look at the history, so we can see that 3 member states of the GCC already implemented VAT from 2018, and nowadays we have seen the news about the Oman. So Oman already announced the VAT law and executive regulation last year, and starting from 16th of April, the Oman will have the go-live date of VAT, and the VAT will be implemented in Oman as well. In Qatar, as of now, the government is silent. However, we would expect that the VAT law and the executive regulation might be announced this year, and with the go-live date of the 2022. However, it can be there can be early announcement of VAT, and therefore it's better to start early, review your transactions from the VAT point of view. So let's move on the basic mechanisms of VAT. How does VAT work in an ideal scenario? So in order to explain the working mechanism of VAT, we took two business units and one consumer as an example, where our production company is charging 5% VAT on its sales invoices to the retailer, and also in its turn, retailer company is charging 5% VAT on the amount issued to the consumer. So each business unit here has the recoverability right, so the purchases VAT, input VAT, can be recovered based on the received proper tax invoices from the supplier companies. So, and if there is a proper tax invoice for those companies, then VAT will not be cost for the businesses. And as a result, the VAT will be cost for the final consumer, and the final 10% Qatari 10 Qatari Riyal VAT amount will be paid to the tax authority. The role of the businesses here is just to collect the VAT and transfer it to the respective tax authority. So as I mentioned, this is the ideal scenario of VAT. However, there are different approaches of the VAT, and I will show you in the next slide with the important concepts of the VAT. So the first one, which I already shared the examples of, 5% of the VAT, which is standard rate. And there are also other approaches such as zero-rated VAT, exempt VAT. And in both scenarios, the differences are about the recoverability of the input VAT from the purchases. In case of zero rate transactions, just export of goods or services, companies will have the rights to recover input VAT from their suppliers. So that in this scenario, in this mechanism, the VAT will not be cost for the businesses. In case of exempt scenario, exempt products, for example, life insurance for insurance companies, so respective portion or respective the tax invoice or the input VAT will not be allowed to recover that amount. So that amount will be cost for the business. So this is the some important concept about the VAT. So with this, I would like to move on the challenges of the VAT, where we collected based on our experiences working with other the companies in the region as well as in the state of Qatar. So first of all, I would say the challenges comes from the classification of the transactions of the sales items or products. So in order to put the proper treatment on the products, the first the process and the challenge in the classification of these items. Then second is, once you have the classification in the systems or ERP systems should be configured. So this is another challenge, and it requires time and a lot of effort. And if you don't have the enough sources in the company, then you should outsource from the outside. So this is another challenge which the companies are facing. And then reporting is another challenge after the go-live date of VAT, where the companies are facing the collecting information from the all business units. Even in case of VAT grouping, it's difficult to collect information and report it to that respective tax authority. So, and the one more challenge can be cash management, especially on long-term credit sales. It's difficult to collect the amount from the clients on time. And however, because of the tax return submissions, the tax amount VAT due should be paid to the respective tax authority. And from here, if I take one example of like transport and logistic companies, in their example, like classification of the provided services. So their transactions can be international transportation or local transportation. In order to put the correct treatment of VAT, that these transactions should be distinguished, and the system also should be configured properly. And with this, I want to answer some few questions regarding the VAT in Qatar. So like science of VAT in Qatar, usually we do receive the questions from our clients, like when VAT will come in Qatar and what kind of science do we have? In our next slide, we cover this answer. Like as we all know about, aware about the situation movement in the region, and also this might have a positive effect on the participating in the GCC agreements as well as the VAT framework agreement. And also my colleagues already covered the technical capabilities of the new tax portal, which is Dhareeba, and we believe that, that this tax portal will be helpful for the GTA in order to manage the proper required actions of the VAT. And also there are some recent partnerships of the GTA with banks, as customs authorities, and that can be used for the VAT purposes as well. And the last one, so upcoming events in Qatar, like Arab Cup, World Cup, so tourist spendings can be the source of additional VAT income for the government. So if we go to the next slide, there are some lessons learned from other VAT implemented countries. Of course, it was not an easy task for the businesses in those regions. So there were delays, there were wrong approaches, there were mistakes in the formatting of the tax invoices, also constructing the engagement letters or contracts, especially long-term contracts. So these are the selected lessons learned from those countries and the businesses. So first of all, I would like to start with the timing of the impact assessment and timing of the preparation. So there were cases for the companies which they started impact assessment late, after the go live date or the announcement, after the announcement of the VAT. So its delayed VAT impact assessment gave a difficult challenges for the difficult moments for those companies. And also there were cases for the companies, they wait for till end of the let's say go live date, and then after the go live date they started making analysis of the transactions, reviewing contracts again, making implementation in the system, and that resulted negative impact on the business from the reputation point of view, from cash point of view. So it's better to start on time and understand the business transactions from VAT point of view. Another part is wrong system configuration and as well as delayed user acceptance testing. So because VAT is a transactional tax, and because of that reason, each step of the process should be reviewed carefully, and proper VAT treatment should be applied in each transaction. So if the system is not ready for VAT, and of course output of the system and also client communications, supplier communications will have a negative effect on those because of the wrong configuration. And from other hand, delayed user acceptance testing. The system was not ready properly, and even system was ready, but no one was educated properly how to use this new VAT, how to extract the information from the system and submit it to the tax authority, how to print and how to prepare the proper tax invoice for using your ERP system. So this is also delayed testing and delayed in training sessions. So that affected negatively. And prior to the go live date of VAT, there were companies which were not ready for VAT fully. And another point is ignore transitional rules for VAT. So the contracts, especially long-term contracts, are affected by VAT, and these rules should be changed. And before the go live date of VAT, respective articles of those contracts should be discussed with the customers as well as suppliers in order to protect the company from extra cash outflow of VAT. Without this, the companies suffered a lot, especially on the contract with their customers and as well as suppliers. Suppliers charged more and customers didn't pay VAT because of there is no clause on regarding the updates on the VAT law. So it was the difficult moment for the businesses in those regions. And the weak communications with vendor companies. As I told you, as I mentioned earlier, so especially So the communication with the vendors with regard to the tax invoices. So wrong tax invoices led to the improper input VAT recovery. And also another point is communications with the customs authority. So if you don't receive the proper import declaration, so you will not be able to recover the VAT. So that is why it was a difficult moment for the businesses. So with this, I would like to move on the next slide, where I will share some updates about the customs. So as I mentioned earlier, there was a recent developments in the GCC region, and one of them was about the customs. As we know that the border was opened with Saudi, and the transactions for individuals and as well as commercial, so already open for the users. And also the GTA as well as the General Tax Authority has signed a memorandum of understanding regarding internal linking of customs and the Dhareeba tax portal. So as of now, it can be used for excise tax transactions, but however, we believe that in the future it can be used, it will be used for the VAT point of view. So therefore, it's better to make sure that your system is ready for this kind of new upcoming changes. So with this, I would like to complete my session and hand over my colleagues Imran and Abhishek for Q&A session. Thank you.
Thank you, Nurlan. Thank you, everyone. We received quite a number of questions. So probably I will ask Abhishek to kickstart the session.
Yeah, hi, Imran, thank you. Yeah, so we have quite a lot of questions, and so the first question is that what is the due date for filing of tax return for FY 2020, and especially when the year end is not December, when you have a different year end. So for example, if the year end is June, so what would be the tax filing deadline? So as you know that the tax filing deadline has been extended. So the initial deadline for June year end is October, but and then based on the new circular, it will be extended by another 2 months. So the new deadline will be December 31st for the year end June. And then accordingly, we will you can, if you have a different year end, say March or September, accordingly you can calculate your deadlines.
But only one remark here. Sorry for interrupting. It is important that your year end is correctly reported or captured into the Dhareeba, because this will be relevant in order to determine your deadline. If that should not be the case, and we know that some companies have difficulties, and also, you know, we support some companies who have difficulties to do that. This needs to be captured now very, very fast and with all means, because otherwise it will not count.
Yeah, hi. Thank you, Barbara. So there's another question on TP, where the question is that whether an overseas branch fall under the related party definition, and if yes, then should the transaction between head office and branch to be reported in the TP disclosure form as well as in the local file? I guess the answer is yes, but Uma, would you like to throw some light on that?
Yeah, like we discussed, that the related party definition is basically driven by what is considered as related party as per the accounting standards. So if these transactions, and will not just if, they will be covered in the related party transactions in the financial statements and as per IFRS, then yes, this will also be covered for transfer pricing reporting.
Thank you.
Yeah.
Hi,
There is the question about like, do we need to file financial statements in Arabic for FY20? So my colleague Khalil has already covered that part in the slide. So basically, there was a circular issued, circular number 14 in 2019, where the General Tax Authority has earlier extended. There was initially an Amiri decree regarding the protection of the Arabic language and the related requirement. Under that requirement, the General Tax Authority issued a circular back in 2019, where they stipulated that the companies needs to prepare the financial statements in Arabic, and they given the deadline that it will not apply for FY19. However, it will be applicable for the period starting from 1st January 2020. We also had some recent discussion with the General Tax Authority, and basically because we understand that the companies were struggling with due to COVID and other requirements to finalize those requirements in Arabic. However, the General Tax Authority response was that that they already given enough time, so all the companies needs to prepare the financial statements in Arabic, and the circular was issued quite long ago. However, we are still discussing with the General Tax Authority if there can be any kind of further relaxation, like first few pages can be translated into Arabic or something like that. But until that, the General Tax Authority instruction is clear. All the companies needs to file the financial statements in Arabic in Dhareeba. I will also, there is another question which is quite an interesting one. How the listed entities will be establishing the tax residency of the Qatari shareholders, or for example, the GCC shareholders. So we understand that it is not an easy exercise. First of all, determining who are the Qatari shareholders. Because you might be having a layer of companies on top of the listed company, and getting the commercial registration or the relevant documents for all the companies may not be easy. That's why we were trying a lot with the General Tax Authority to kind of give some relaxation, and the report which is being produced by the stock exchange can be used for determining the foreign shareholding. However, the General Tax Authority response was quite clear that they are granting an exemption, and the exemption will be granted only if you can prove that that only this much percentage is foreign shareholding and the remaining is Qatari shareholding. And with regards to determining the residency requirement, for Qataris, we understand the residency requirements are relatively easy to meet, and most of the Qataris should be able to meet the residency requirement. It includes various conditions, and if any one of the condition is met, they will be considered to be resident. One of that is 183 days of residency in or stay in Qatar. However, if they have a permanent home in Qatar, which usually will be the case, or their center of vital interest, or a family or a business interest are being located in Qatar, which usually be the case for the Qataris. So it is not that hard to meet that requirement. However, the tax authority might require that also to be proven. But generally, for Qataris, we believe that the residency requirement should be relatively easy to meet. However, determining that who are the ultimate Qatari shareholders might prove quite difficult also. Abhishek, with that. Hand over to you.
Hello.
Abhishek, yes.
Yeah, thanks, Imran. Yeah, so there is another question on contract reporting. I think this is from the clients operating in retail sectors, that whether the contract reporting requirements are applicable to retail sectors. So the answer is yes. The contract reporting requirement is applicable on the taxpayer, irrespective of the industries you are operating in Qatar. There is the next question is on VAT, which is so I would I think direct this question to Barbara. It says whether any VAT laws are issued, and when do you think it will be implemented in Qatar?
Okay, happy to take this one. Maybe just before on the contract reporting, one thing to add. Yeah, as Abhishek mentioned, it's applicable to everybody. However, there is a threshold. I think for services, the threshold is 200,000 Qatar riyal, for goods and services, or combined 500,000 Qatar riyal. So for the, let's say, retail sector, this might help a little. On the other hand side, it's important to mention that when you enter contract in the system in Dhareeba too late, the system is automatically generating a penalty of 10,000 riyal. So it's really quite sharp, and the tax authorities, they are not discussing a lot around that. So it's really important to get this right. Then on the VAT question, the answer is not yet. So there are laws in draft versions are around. However, they say not much more than you can already read in the GCC framework agreement, but nothing final has been issued yet. The tax authorities, they keep on saying that they are ready. I think in one conversation I had lately with them, they were comparing themselves with F-16, so ready to take off when needed. So let's see whether this will be true. But as mentioned by Nurlan, what we expect currently that the law will be released around mid-year and then enter into force would be 1st of January 2022.
Thank you, Barbara.
Yeah. Thank you, Abhishek. There are more questions about Arabic financial statements, and also there is an accompanied question that does the simplified tax return needs to be accompanied with the Arabic financial statement. So the answer to that, first of all, that whether the audited financial statements are required. That's one of the questions connected with the simplified tax return. We understand that the General Tax Authority has not issued any detailed rules about the simplified tax return, how it will be, what documents needs to be attached, etc. The circular just talks about that it needs to be accompanied with the financial statement. It doesn't talk about whether it should be audited. That's the background. However,
I think Imran, I think you are somehow on mute. At least I cannot hear you. Can you try?
yeah, sorry.
Yeah.
My internet got disconnected. So with this period with the COVID, we are struggling a little bit with the technology. Yeah. So the question was whether the companies need the simplified tax return needs to be attached with the Arabic financial statement. So first of all, the question is whether what companies needs to filing the audited financial statement. So the answer to that question so far is until a further relaxation is provided by the General Tax Authority is in the law or in the regulation, which stipulates that if the capital is more than 200,000 riyal or the annual revenue is more than 500,000 riyal, tax return needs to be accompanied with the audited financial statement. Similarly, when we read circular number 14, which stipulates the requirement of Arabic financial statements needs to be filed along with the tax return, there is at that point in time no mention of a simplified or a detailed tax return. So in the absence of any relaxation, we believe that the simplified tax return needs to be accompanied with the Arabic financial statement until any further relaxations are being provided by the General Tax Authority. Just also a quick remark about the deadline. So we might be hearing something probably in the near future. The deadline for those exempt entities with the simplified return is within a period of another 4 months extension is granted. So that will be by 31st of August. And we hope that the General Tax Authority will issue some more detailed rules about the simplified returns, because that's we understand it is still not a very clear area for companies. Barbara, you would like to add anything?
No, I think it's perfect. Nothing to add.
Yeah. There is also a question about the contract reporting that we understand that, okay, I will probably just a little bit redraft that question, that what the General Tax Authority is looking into it, what they basically want to achieve, because the companies understand it's quite a detailed template, and some of the information may not feel very relevant to some of the companies. And also the companies are also seeing that it might even require some further resourcing by them to complete that template. So as my colleague Khalil mentioned, there are a few things which are quite clear that they want to kind of achieve from that. One of them is about withholding tax. If the payments are being made to a foreign entity, you will be reporting those contracts. So the General Tax Authority can understand more from the nature of those contracts, whether those are for supply of goods, for services, with whether those are composite contracts. So those elaborated information might help them in determining whether it should be subject to withholding tax or not. Similarly, the transfer pricing provisions may, because it has some detailed information, so it might be helpful for the tax authority to understand the related party, the terms and nature of the transactions in more detail, which party is bearing what risk, etc. And similarly, maybe they can determine in the future that how much remuneration is attributed, how much, whether it is at arm's length or not. So that can be achieved similarly with the detailed level of information. However, we understand the concern of the companies that that the information required there is very detailed. It goes well beyond what is stipulated in the executive regulation. And we are trying to the General Tax Authority that they should probably either issue a more simplified version of the contract reporting template, which can achieve the same purpose essentially, or they should allow companies to upload, because we also understand that the quantum of the contracts for some companies is quite huge. Abhishek mentioned one example of the retail sector, similarly the banking sector, or if we see telecommunication, or we see the construction companies, the number of contracts could be huge, and manually inputting those data in the Dhareeba system is very time consuming, and the benefit may not, like the cost which the taxpayers will be incurring may not be really, it will be quite huge for the companies. So we are discussing with the tax authority how they can simplify that. With that,
Yes, just one thing to add. We also receive a lot of requests whether, you know, is this applicable to our sector because of, like, as I mentioned before, because of amount of contracts report, or because of confidentiality concerns. At the moment, the answer is yes, it's applicable to everybody. We have some requests asking for exemption for specific reasons, but so far the tax authorities have not granted any exemption. So it's at the moment, it's really we need to deal with what we have and maybe start to convince the tax authorities whether we can summarize some information, or how it can be simplified, but we are not yet there. So at the moment, it is what it is, and the tax authorities are insisting.
Yeah. So like I will also echo Barbara's word that that as of now, the penalties are quite huge. So regardless of the system complexities and the detail of information required, everyone is required basically to comply with the law and the regulation and the Dhareeba. Otherwise, they will be liable to penalty of 10,000 riyal and for any delay. So we highly or strongly recommend all the companies to comply with this provision, regardless of the complexity or the resources required, because the worst outcome which can come in penalties could be quite huge and severe as compared to filing that information in Dhareeba. With that, Abhishek, more question.
Thanks, Imran. So there is another question on the requirement of the local file. So the question is, if the company do not fall under the 50 million threshold, but still they have cross-border related party transactions, so do they need to keep the local file ready, or as the GTA can request anytime the local file in future? So Uma, if you want to answer this question.
So the upfront filing of local file will be applicable only if you cross the 50 million threshold. However, one should remember that there is a basic expectation by the regulations itself that a taxpayer should have done a functional and comparability analysis around their related party transactions. So at least document a TP analysis that covers functional analysis and comparability analysis for each of the transactions should be maintained by each taxpayer.
Thanks, Uma. There's another question on the transfer pricing again, which is which are the transfer pricing method that can be used for justifying ALP, which is arm's length principle?
So the methods are basically the same as per the OECD method. So you have the comparable uncontrolled price method, resale price method, cost plus, profit split, and transactional net margin method. You do have some flexibility in the TP declaration to mention others if a particular transaction is unique enough that it cannot be modeled under a particular method. Then you have the option to say others in such cases.
Imran?
I received a question about the VAT. So the question is from your experience, what examples of systems you can provide which have proven successful? They are simple as well as handy for managing VAT. And probably I would like to add that to Barbara that why it is necessary that the companies need to start looking into this matter now rather than just waiting for the law. The last part is mine.
So okay, let's start with the second part. I think it's VAT is a very complex tax, not like other taxes which can be dealt with by the finance department only. VAT will have an effect on the entire company, so everybody will be affected. So that's why it's really important to start early, because it will require you to clearly allocate responsibility and information flow from one department to another. So it's more complex. That's why it requires more time. So that's why the earlier you start, the better it is, because otherwise you will really struggle. And furthermore, all providers probably will be sold out because we have seen this in other jurisdictions. So it will be very, very difficult for you to find somebody who can help you. And of course, the prices will go up. So that's the reason why it is very, very advisable to start soon. The second question on the system, unfortunately, there is no one-fits-all solution. So if you would have that, I would also buy it myself. It really depends on the company, how complex the company is and also what kind of ERP system the company has. So for a smaller size, mid-sized company, a good ERP system can be enough, because the rest you can do manually if your ERP system provides you the report you need. If you have a larger, more complex company, then it might be advisable to have a specific VAT software. But really it depends on the complexity. There are different solutions on the market, and we of course know them. And we're happy to advise, but I'm very reluctant in telling a name here, because it's not, that you could have one simple thing and you just plug it in and it will work. That unfortunately does not exist. So it's always a lot of manual work, a lot of assessment in the background, and what is right for you might be wrong for another entity. That's why it's really important to look into that in more detail.
Yeah, so probably after the session, you can give us a call and we will be happy to answer that further.
Of course.
Yeah. So there is another question about it is about country by country reporting requirements. So the question was if the ultimate parent entity has filed the CBCR report in another country, whether they are required to file any notification or intimation to the General Tax Authority. Maybe I can answer that myself. So the CPCR, the notification requirements are still suspended for ultimate parent entities who are complying with the CBCR obligation in another country. So they are not required to file any notification as of this date to the General Tax Authority if they have filed their CBC report in another country. So the answer is there are no notification requirements in Qatar. Abhishek, another question.
There was a question on the transfer pricing declaration, whether it is mandatory for fully Kuwaiti companies or GCC-owned companies to file the transfer pricing declaration. I think I can answer this. Yes, the transfer pricing declaration is mandatory, subject to the threshold, whether the company is 100% owned by Qatari, GCC, or foreigners. There was another question on the contract reporting penalties, whether it is the 10,000 Riyal penalty is for per contract or per month. So as I think clarified earlier also, that the 10,000 Riyal penalties for each contract for delay in notifying each contract to the tax authorities.
Yeah. So there is also question about, again, Uma, about the TPD, local file and master file. So the question is that all these requirements, whether they are applicable for FY20, like the period ended 31st December 2020, and what are the consequences if someone doesn't comply with these obligations, including the the TP declaration, master file, and local file. Uma, you would like to talk?
Thanks, Imran. So yes, they are fully applicable for financial year 2020. The TP declaration, basically what's important to note is that the tax return cannot be submitted without the TP declaration. So non-filing of TP declaration would basically result in non-filing of tax return. So the tax return itself will be delayed, and then those penalties will automatically apply, the ones that are there for delay in filing the tax return. For master file, local file, there is no specific penalty on delay as such. So it's not mentioned and not specified. However, one would still want to look at the risk that there could be similar penalties being applied for delay in filing master file and local file. The other thing is that there is a broader penalty which is being covered in the law for non-compliance of let's say BEPS actions and automatic exchange of information regulations, and those are very significant penalties. There's a limit, but those could be significant, and if this is considered as a BEPS action plan, there could be a risk that department would want to look at those penalties as well, though it's not a direct linkage is not really there so far. I hope that helps.
Yeah, thank you.
I would like to add just one point to what you said, Uma, is that if the master file and local file are not submitted, it's not, even if there are no penalties specified for now, but the master file and local file will be used by the tax authorities to assess for purpose of tax assessment as well. So if they don't receive this information, so maybe they will issue some kind of presumptive tax assessment, etc., because they don't have any information on the related party transaction. So there is a high area of risk as well. Thank you.
Okay. Thank you, Khalil. Uma, there is another question about the transfer pricing, what are the TP guidelines, methods, etc. for domestic related party transaction, since TP declaration covers domestic related party transaction as well. So Uma, if you can elaborate whether there are any separate guidelines being issued by the General Tax Authority for a domestic related party transaction, and whether there are any simpler requirement as at this stage for a domestic related party transactions.
So there's no specific separate guidelines for domestic transactions. So first element is correct that it will be covered in the TP declaration. Then of course the question comes whether it will be covered, whether there is a local file requirement as such on the taxpayer. So do they also have foreign transactions, and do they also cross the threshold for local file? Then one would, if a local file is being prepared, one would might as well cover these domestic transactions over there, because as I said, there is a basic expectation that there is some level of analysis being done by a taxpayer, even at the time of entering into a transaction, to ensure that a transaction is at arm's length. So from keeping in perspective that expectation, a local file could cover the domestic transactions. And where a local file is not applicable per se, again, I would say that there is at least some level of functional and comparability analysis should be maintained by the taxpayer.
Thank you. Bishop, you want to ask any other further question, answer?
Yeah, there are some more questions. One is that regarding the contract reporting, which is whether the lease contracts are subject to contract reporting requirement. So the answer is yes. If the lease or the rent, the value is more than exceeded the threshold provided in the law. There is another question on the withholding tax, which I think they ask about the new tax law which was introduced in 2018, and then subsequently the executive regulation which were issued in December 2019 replaced the performance test by consumption test, and there are services which are now subject to WHT under consumption test. So I think the question is that wanted to understand the effective date from which WHT should be deducted on such payments which satisfy the consumption test now. So as you know, this new provision was introduced in the executive regulation, which is effective from 12th December 2019. So the effective date of the consumption test is 12th of December, provided that the services also rendered after the 12th December 2019. So if you have you know, the transaction where the services were rendered prior to 12th December, but only the payment made after the 12th of December 2019, then this provision will not apply. So in order to apply the consumption test, the services should be rendered after the 12th of December 2019.
And if you have a contract or an invoice who is covering, you know, services who are before and after, you need to split it. So it's a pro rata temporis split. You would do that.
And I think,
sorry, I just saw there were some other questions on the deadlines on transfer pricing declaration. So transfer pricing declaration always goes with, has to be filed together with the tax declaration. So if you have an extension there, then yes, TP declaration will have to be filed together with the tax return, always. The only thing which is open at the moment is Masterfile and local file, because there, you know, the circular or the correspondence with the tax report, it specifies the date, which is end of June, and they don't say 2 months after filing of the tax return. And so far, we have not received any correspondence on whether the master file and the local file, whether this deadline will also be extended. That's why at the moment, as Uma said, we are looking at the deadline of the 30th of June. This might change, but at the moment, there is no other correspondence.
Thank you, Barbara.
Thank you.
Yeah, sorry.
Yeah, there is probably one last question which I can take it, that our pure supply contracts are also subject to contract reporting requirement, and an example is being given here where the such supply is being provided by the head office to its branch in Qatar. So whether that is also subject to contract reporting requirement and needs to be entered in the system. Khalil, you would like to elaborate or answer? Or I can answer. Yeah, so I can take that.
Okay. You can take it.
Yeah. Okay, thank you. So yeah, the pure supply contracts are also needs to be reported, as we mentioned earlier in our previous webinars. There is a limit of 200,000 riyal for a service agreement and 500,000 riyal for supply of goods and contracting and other such contracts. That is for the local parties. However, there is no limit for the foreign party contracts. Here, as the question was specific to the head office, which is outside of Qatar, so these contracts needs to be reported regardless of the limit. However, such contracts also needs to be reported if the transaction is between the two domestic parties and the value exceeds 500,000 riyal. So the answer is the pure supply of goods needs also be reported. And as my colleague Khalil mentioned earlier, the GTA might even be trying to match it further with the VAT. So it may not seem very relevant because it is not subject to withholding tax as of this date. At this stage, the supply of goods are not subject to withholding tax. However, there might be VAT requirements. So the department might like to cross match it with what is the customs being paid, or what are the input the VAT at the import stage of such supply of goods is being charged. So they may need that information for other reasons. So it needs to be reported.
Yes, maybe I can take another one. We are almost come to the end. But first of all, we have received several questions whether we will be sharing the slides and the recordings. Yes, we will. So we will all send an email to all participants with those two things. And then maybe the second question I have seen coming up quite a lot is what to do contract reporting with a backlog, because a lot of entities they were not filing it like correctly in the past, and what to do. Unfortunately, there is no safe answer to that, and we also don't know how aggressive the tax authorities will treat those cases. What we try to argue is that, you know, before Dhareeba, there was actually no form really provided, and it was not clear how you should file those contracts. And what we recommend is trying to either not reporting and just trying to argue that there was nothing ready, or try to report manually, meaning in an Excel. The problem is if in both cases it's likely that the GTA will issue penalties, and then you need to try to fight it with the argument that they have not really, you know, provided a platform. So there is unfortunately no, again here, right or wrong answer or no answer which has no risk. So that's probably all I can say to this point. I don't know, Imran, Abhishek, maybe one last question if you just have one, and then
I think it's not a question. I think the lot of people are asking about the recording and the presentation. So I think we will share, yes, the recording as well as the presentation with all the attendees.
Yeah. So with that, I would probably ask Barbara to just give some closing remark, and then hopefully the next session we can have next year annual summit in physical.
Yes, so I just would like to thanks to everybody. I think we could have extended 1 more hour. We have so many questions, so we will try to summarize and provide, you know, to you with a short answer if it's not too specific, but we will try to cover them. I enjoyed it. I enjoyed the discussion, and as Imran said correctly, I really hope that next time we can meet physically again. As nice and as efficient those webinars are, meeting in person is still my preferable thing. So I would like to thank you all for participating, and hope to speak to you soon again, and stay safe. Thank you very much. Bye.
Thank you.
Thank you.